Candle range theory trader with you for a deep study on using the candle range theory and the average true range. So let's go. Now, what is the average true range? It is a technical indicator that's going to show you market volatility by looking at the entire range of a pair's price for a specific period. So all the AT does is measures how much price has moved on average over a set time frame, typically 14 periods, okay? But it is not a trend indicator. It does not show you which direction a pair is going to go. All right? It only shows you yes, this pair is moving a lot, or no, this pair is not really moving all that much on average. Okay, that's all it does. It's like a ruler. Okay, so it's not going to tell you which direction to trade in. All right, but we can still find it useful. So how do we read it? If you pop it on your TradingView chart and just type in average true range, it's going to pop up. It'll be this red number that will appear on your chart, and it will show you the number of pips that a pair moves in any given time frame. In this case, it will be 7, not 71. So you'll kind of have to use common sense, but or you could just measure the pair real quick and see how far it has moved. If a pair has a high ATR, that means it's more volatile, and a lower ATR, it's less volatile. So it's just going to depend though on what time frame you're on because it will change every time you change the time frame of the chart you're looking at. So how can it be used? Four main ways. You can use it to find possible reversal zones or candle two areas, high probability areas where candle two could play out. Stop loss placement, take profit placement, and dynamic risk management. So first off, let's go over the reversal zones. So whatever time frame you're trading, okay, whatever time frame you're looking for a candle three on, you're going to look for a higher than average true range for a possible reversal. To keep it simple, what I like to see is a clean trending market and the ATR being higher than normal. That tells me that, okay, it could be setting up for a possible candle two and then a candle three at the most. I'm not talking about trading state trend. I'm talking about just getting one good candle three. All right. So here's an example. So here we have a clear downtrend, obviously, because the candles are moving down. This is an 8 hour chart because I trade the 8 hour chart. So if you use 4 hour, daily, just whatever it is, whatever candle you're looking for candle three on, that's what chart you should be looking for to see possible candle twos. So as we see here, with price going down, the average true range, where is it? It's higher than it's been for the past few 8 hour candles. It's been going up, up, up. So that means it's more and more volatile, right? The averages are higher than normal, okay? Because it's been since what is this, the fourth of the month, since before the fourth of the month through the 12th of the month, it's just been getting more and more volatile. So when it's this high and I see that it's been on a downtrend, now I'm looking for candle twos, but because it's on a downtrend, okay, it's just been going down. It's just that simple, okay. I'm just looking for a candle two to show me a possible green candle three, and it happened right here. So you had candle one, candle two, and candle three. So it's like in three stages: clear downtrend, high ATR, possible reversal. Okay. Now I'm not talking about getting all these candles because this could happen, but I'm talking about just one main candle three. I'm not talking about trading trend reversals. That's not the point of this video. Okay. Have to take a quick sip of water. All right. So let's take a look at another one. And that's why I say candle three, because if you see here, price chopped around, but you did have a pretty clear downtrend, high ATR. So then you had candle one, candle two, candle three right there. Okay, that's it. That's all I'm trying to get right there. I'm not trying to get all of this. I don't care about all that. I'm not a trend trader. I only trade one candle. That's candle three. Okay, because anybody who tried to hold on for longer, they might have got stopped out. Okay, on this big return back here to the level. All right. So, and then you also notice here another candle. I didn't isolate it, but candle one, candle two. This out right here also is a candle three. Okay, so you can try to get continuations off of that, but this was the main price action I'm looking for right here. Candle one, candle two, candle three, after seeing a downtrend and a high ATR. Okay, take a look at another one. Got a clear uptrend, a very high than usual ATR, big old spike. So then you have candle one, large candle two, and then candle three to the downside. Okay, I think that was probably news driven, but at the end of the day, the clear uptrend and the high ATR let me know, okay, it might be time to look for a candle two and then just trade candle three. But you always let candle two play out before you start trying to take candle three. Okay. And then here's one more. So you have a clear uptrend from from here all the way up. So where's our ATR? ATR is very high. Okay, higher than usual. Okay, remember this isn't trend though. This just shows the pair is getting more and more volatile. So it's higher than average. So I expect candle one, candle two, and then candle three. And it gave you all of that. Okay. So that's that. So remember, high ATR, market's moving. Low ATR, market's chopping, consolidating, may or may not be worth trading. So now let's talk about the next usage case, which is stop loss placement. The easiest way to use the ATR for stop loss is just using multiple of the average true range for the time frame that you're trading. I trade the 5 minute chart. Some people trade 15, some people trade 1 minute, whatever. Whatever you do trade though, get the ATR indicator on your chart and base your stop loss on that. So for instance, with me, if I'm trading the 5 minute chart and I see that the average true range is 10, so that means in 5 minutes, a pair typically moves 10 pips, right? On average over the last 14 candles. So I can set my stop loss based on that information. So I can do a 1.5 times ATR, which would be 15 pips. I can do twice the ATR, which is 20, which is what I normally do. Or I could even do 3 times the ATR. So remember, whatever price has been moving, you just trade the market as it actually exists. You don't make up some random number. I'll do a 50 pip stop loss. Does that really make sense? Because price is nowhere near moving 50 pips on average. You're probably not going to hit your stop loss or your take profit for a considerable amount of time. But if you know that in 5 minutes the pair moves 10 pips, then you're increasing your likelihood of something getting hit, be it the stop loss or the take profit. So let's take a look at a real example. So this is New Zealand yen. This is the 5 minute chart. And on this 5 minute chart, the ATR at the time is not shown here, but on the chart it is. Oh, well, it is over here on the far right. It's about 4 pips, 4 pips, okay, 0.34, okay, so there you go. So you can do the stop loss at 15 pips, which is a little over 3 times the ATR, okay, and if you would have took that entry, the take profit would have been hit, but I'm basing it on how the pair is actually moving in real time. I'm not making anything up, okay, so that's where that comes from. Now, another method you can use for stop loss, if it's too big for you, you can use the division method to make it smaller. So let's say if a person's trading the 1 hour chart and the ATR is 40 pips, okay, but you think that's a little too large, then you could just divide it in half, like 26 pips, or, the ATR divided by 1.5 times 2 will be a 20 pip stop loss, or by 3 will be a 13 pip stop loss, either way. Okay, so that's another way. So you can either multiply it or you can divide it to toggle your risk management. It all depends on how much risk you're willing to take. Now, you can also use it for take profit placement, because if you want to do that, you can use a multiple of the ATR as well. So same thing, if you use a trade in the 5 minute chart and your ATR is 10, set your take profit to twice the ATR, which would be 20 pips, 30 pips, or even 50 pips, okay? Because it could hit it, theoretically, right? But remember, it means on average. So let's take a look at an example. But you already know, okay, the pair is moving 10 pips in 5 minutes. So it's not unrealistic to possibly think it can go 30 pips, right? It's been moving 10 every 5 minutes. You got a good chance it can go 30. Okay, but not 100. That doesn't make sense. Okay, so it depends on what you're trading. All right, so same chart that we saw earlier. This is New Zealand yen. And this was again, 4 pip ATR on the 5 minute chart. So I could just set a take profit to 28 pips. That's actually 7 times the ATR, okay, which is up there. It's just simultaneously, I use the candle range high as another guide as well. But this is just extra confluence, okay? So because I know that the pair moves about 4 pips in 5 minutes, it's not unrealistic to assume that over multiple 5 minute candles, it could move 28 pips. So that would be that. That's the rationale behind it. And as well, if the ATR is too big for you, you can also use the division method using the same rationale I mentioned earlier. If the ATR is 40 and that's too far away for you, you just divide it, divide it by 2, by 1.5, or by 3. Either way, okay, it's up to you. Now, as well, for my one-to-one risk reward folks, if you just want to use the ATR and use the one-time multiplier, just set it and forget it. You can do that. So this is a dollar CAD chart, and it's a fairly low volatility pair. It's only 2 pips. Okay, 2 pips. All right, in 5 minutes, very low. So you just 10x the ATR, 20 pip stop loss, 20 pip take profit, and just let it go. And if you want to scale in, you can do that too, or you can just set it and forget it. So if you want to set it to, win 100, lose 100, it's up to you. But again, it's based on how far the pair is actually moving on average. So now let's take a look at some volatility aspects with ATR, because we have to remember with a 20 pip ATR, if you're looking at a low volatility pair like the one I just showed you, where it moves 2 pips every 5 minutes, it wouldn't make sense to set a 100 pip take profit. You're going to be in that trade maybe all week, right? But you can still make money on low ATR pairs. So let's say you did a 1-to-1, you can risk 100 to make 100, and your odds are very likely of success, keeping in mind the 20 pip ATR. But if price has a 60 pip ATR, Would it still be worth it to risk $100 using that same risk structure? Not necessarily. You can keep your risk dynamic. You can risk $33, and the odds of your success will be higher for a similar return of making $100 doing on 1 to 3 or more. So let's take a look at that example though. Let's see it played out. So this is a very low volatility pair, New Zealand Swiss. Okay, it's a 2 pip. It moves 2 pips every 5 minutes, right? So let's say you did an 8 pip stop loss, 8 pip take profit, right? And it's going to just hit it, or it's going to hit one of them, right? The odds are pretty high of that based on what's actually happening, right? So you take your entry, and you would have been out in fairly short amount of time because you did catch a good candle 3 and it just trended up and it moved 8 pips, right? So this could have been $100 in your pocket, done deal. Okay, fairly easily, right? On a low volatility pair. But now let's take a look at the other one. So this is a higher volatility pair, which is pound New Zealand. The ATR on this one is 10 pips in 5 minutes. So more than 3 times of what we just saw in New Zealand Swiss. So what you could do on this one is a 20 pip stop loss, twice the ATR, and a 40 pip reward, which is 3 times the ATR. That's a 1 to 2 risk to reward ratio. Guess what your profit is? $100, right? But if you know that the pair is moving 10 pips in 5 minutes, it's not unrealistic to think that it can move 40 pips, okay, in a reasonably short amount of time, which it did do. Okay, but you see how it's based in the actual market as it's taking place. Why would I set a 100 pip take profit on this if the it's only moving 10 pips on average? Right? It's going to take forever to hit my TP. Now, if you're a swing trader or depending on your time frames, you can do that. Like if you're trading daily ranges, okay, that makes me more sense. But for me, no. I like to keep it in the context. I don't want to be in the market all day, every day. I really don't. I want to know immediately if my bias is right or wrong. And then here's another one. Here's that same chart, but here's a 1 to 1. So because the ATR was 10 pips, you could just do a 20 pip stop loss, 20 pip take profit, risk $100, and just be done. And the 20 pip reward would have hit fairly quickly after some consolidation, and then boom, it was out in like 2 candles at the end of this box here. So if you want to enter it here, it chopped around, but then eventually, boom, boom, because it is going to break one way or another. Okay, it's just a matter of being on the right side of it. So it's all ATR based. That's what I'm saying. So remember, if you have a low ATR pair, like for my example, at least with what the time frame that I trade, the 5 minute, it will be like 5 pips or below. And then I would consider a high ATR pair for the time frame that I trade, which is 5 minutes, probably like 6, 7, 10 is the highest I've seen. Okay, so like that. But it depends again on the time frame you are trading. That's what I want you to get. So if you're using a low ATR, you can definitely use a tighter stop loss and a larger lot size. If you're trading a high ATR pair, you want to have a wide stop loss and a small lot size, and you can make the same amount of money is the point. So that should be very exciting. So now you can trade anything, okay, as long as you have the money to do so. So in conclusion, all stop losses and take profits should be a multiple of the average true range. Okay, that's going to give you the best odds of success. You're trading the market as it is actually playing out, not as you wish it would play out. You can trade any pair without fear. Just play the averages. You can also resolve to stay out of low ATR pairs, and you can stick with pairs that are actually moving. All right. But remember that if you're a candle range theory trader, the pattern outweighs any indicators. You need that candle 1, candle 2, and then you go to candle 3. That comes first, not the ATR. Okay, the ATR does not go above the CRT pattern. The pattern goes first, and then you line up the ATR. You make the ATR work for you. Okay, ATR works for CRT. CRT does not work for ATR. All right, because even if you have a high ATR, without candle 2, you shouldn't be trading. All right, without candle 2, you are not to take any trades. So pattern comes first. So, but I hope that you find that information helpful. Like I said, throw it on the chart, experiment with it, see how it works for you, set those stop losses and take profits. If you have any comments or questions, you can leave them in the comments. You can like and subscribe. I thank you for your time and attention. Have a great rest of your day. Take care.